Hello, good afternoon. My name is Claire Haverson and I'm here with my colleague Lydia Southern. We are going to speak to you today about tax inquiries, the different types and how to handle them. We'll also answer any questions that you have at the end. So now I'll pass you over to Lydia. We'll start off with talking about section 9A inquiries.
Thank you, Claire. Okay, so the first thing is, when you see one of those brown envelopes when you come through the door, even for me as a tax professional, and probably the same for Claire, it's quite a daunting thing to see on the floor. So the way that we're going to go about this is kind of, what to do, how to sort of approach HMRC, any sort of myths, because when you do Google this sort of stuff, there are a lot of conflicting information. So I think it's important to sort of set the record straight and just give it to you in the sort of the most simplest view. When you receive a section 9A, that's a formal inquiry from HMRC. They have a 12-month window to issue you with this inquiry. Obviously, don't panic. The first thing I would suggest doing is when you receive this letter is checking that the actual inquiry has been issued correctly. This is within the 12 months, so it's very important for you to make a record of the date that you submitted your return. If you don't have that date to hand, what you can do is go on your self-assessment statement, on your account, sorry, and on your account it should have the date that you submitted. If you don't have easy access to your account, what you can do is give HMRC a call. When you give them a call, they should be able to tell you the actual date that you submitted your return. If, however, that HMRC have issued it a couple of days after the 12 months, that actually makes the inquiry not valid. And what you can do is you can write to HMRC explaining that the actual inquiry is out of time, and you can request that they close the inquiry on that basis. Reasonings why you would actually receive an inquiry quite varied. HMRC can actually issue you with an inquiry when your tax return is fully complete. That would just be a sort of a random inquiry and should be quite straightforward to resolve. HMRC can also issue inquiries which are based on risk. I think they have an amber and a red risk. Unfortunately, you won't know which one you would fall under, whether it would be the amber or the red, and HMRC would never actually tell you that. So one of the reasons why you might actually have the inquiry is from a system that HMRC have, which is called Connect. That's a computer system. It's a supercomputer which has sort of access to a lot of contributors. There's sorts of banks, credit card, land registries. HMRC can actually even use your social media to compile evidence. So if you've got lavish spending on there, you're driving around in really nice cars, but your tax return says that you earn $15,000 a year, HMRC can actually raise that as a reason behind to open an inquiry. So just going to move on. When HMRC send you the inquiry, they might actually put on the letter that they are just looking into the return and you don't actually need to send them any additional information. So it's important when you do get the letter that you do look at the what I need to do now section. If they say that they don't need any information, what that will mean is that at that moment they're quite happy with just opening an inquiry within the timeframes. But they'll be in touch in the future when they know what exactly they're looking into, or they've compiled a sort of a long questionnaire, which obviously we'll show you some examples in a minute just to sort of put that into perspective. If you look at the actual letter itself, it should give you a date. That is the date that you should respond by. What also will be on there is the direct number and usually the name of the caseworker that has sent that inquiry letter. If you believe that you won't be able to respond within that sort of time frame, what you can do is just simply give them a call. I would always advise trying to speak to the actual person that sent the letter and just requesting an extension on that. You can also speak with HMRC directly via email. That obviously comes with, some sort of problems in the sense that, HMRC might not receive it, and, emails can quite easily go into spam or get lost. If you do speak to HMRC on the phone or sometimes even via email, what I would suggest is getting confirmation from HMRC via written communication that that extension has been accepted, just to avoid any potential penalties there, which we'll go on and explain in a minute. So let's just go on to the next one. This will give you some examples of a section 9A. As you can see from on the screen, there's the date at the top. So that's the date the inquiry was opened. So that's the date the actual taxpayer was notified. So if you read where it says, "Thank you for your return for the year shown above," that's obviously the year that the inquiry relates to, which was received on the 16th of February 2017. So clearly from this letter, you can see that the date that the actual return was submitted has been put in the letter. That isn't always the case, but it tends to be the case as well. If you look to the top right section there, that is the actual address that HMRC have sent this letter from. Always respond back to the address of the most recent letter. I think this letter is actually a bit old, so they have actually changed from the Bootle address. But again, just double check that the address that's on there is obviously the address that you're going to send that letter back to. It also has on there, just slightly below the address, the best contact telephone number. Again, always call the one that's on the most recent letter. If you move slightly down to just above what I'll be checking, it's really important that when you do get an inquiry letter that you check to what provisions the inquiry has been opened under. We'll go on to explain discovery assessments later on in this webinar, but as you can quite clearly see from this letter, it's under the section 9A of the Taxes Management Act, which has to be within the 12 months. It goes on in this letter to say what I'll be checking. This is usually the best indication to see exactly what HMRC require from the response. In the next slide, there's an example of a longer inquiry letter with specific questions, but this one here is quite a just a general letter, just to make sure that HMRC have opened the inquiry within the specified time and exactly what they're looking into. So you can quite clearly see there, it says that they're looking into income and any loan arrangements. So this one's quite specific to contract to loan agreements. What I need to do now is a section underneath that quite clearly says what you need to respond with. So it would be that section that you'd base your response on. For a letter like this, it's obviously quite straightforward. They just want loan values. For more in-depth inquiries, it might be worth speaking with an advisor to see exactly what you can and can't, or shouldn't, sorry, send. And then on this one, it just has the date that a response is needed by, so you can quite clearly see it's from the 7th of July that the date was that the letter was received, and obviously by the 19th of August is the response. So that's around the sort of 30 to 40 day mark. Again, if you do need an extension, just make sure you contact HMRC and ask for that. This is an example of a bit more of an in-depth inquiry. So this would have been opened under the same provisions as the previous letter. This one is separated out into information and documents. As you can see, if you can make that out, some of the questions are quite basic, start and finish dates, etc. So it is this kind of a questionnaire. It's more the document stage that gets a bit more difficult. These inquiries should be opened within the 12 months. So ideally, you should be able to have access to all of the documents. That's why it is important to always keep records. Again, there are some questions on there, such as there'll be promotional material. You don't really need to send that in inquiry. It's stuff that is only applicable to your actual tax position. So again, it might be worth speaking with an advisor if you do receive an inquiry that is as in-depth as the example that's on the screen. Just to continue on this, interest is that starts to accrue from the date that the tax should have been paid. We've put an example on there which should explain it quite easily. If an inquiry was opened into the tax return for the year ending 5th of April 18, interest will begin to accrue from the 31st of January 2019. That's the same going all the way back. So interest is something that you should always bear in mind when you do have an inquiry. If you do want to prevent further interest accruing, you can make payments on account. So when you make a payment on account, that will prevent further interest accruing. The only way you can have an inquiry closed is via a closure notice or through a settlement agreement with HMRC. Closure notices are issued once the inquiry has reached the conclusion, whether that's in favour of the taxpayer or in favour of HMRC. If you do request a closure notice and it's refused, you can go to the tax tribunal and request a closure notice. That will obviously bring a conclusion to the affairs. HMRC will have to demonstrate, if you go to the tribunal, that the request is unreasonable. For example, if you have an inquiry that's opened in the February and you request a closure notice in the July, HMRC will argue that they've not had sufficient time to actually inquire into that return properly, so they're likely to reject that claim. There's no maximum time an inquiry can remain open. A lot of clients, see this as quite, scary. The fact that they might have had a letter back in 2005 and had minimal contact with HMRC since. Until you're issued with the closure notice, that inquiry does remain open. So please bear that in mind again with interest. And if you do want an update on where your inquiry is at, if you do write to HMRC, it's well within your rights to ask for that closure notice. So I'm going to pass you on to Claire now, who's going to go over Schedule 36 notices and what they are.
So Schedule 36 relates to HMRC's information and inspection powers. It is fairly likely that you might receive a Schedule 36 notice during the course of a Section 9A inquiry. So what is a Schedule 36 notice? It basically gives HMRC powers to obtain information and documents. They have the power to issue a written request known as an information notice, which asks the taxpayer to provide information or documents that are reasonably required by HMRC for the purpose of checking your tax position. They also have the power to enter business premises and inspect those premises or the assets or documents on those premises. They must usually give the occupier at least 7 days notice, and that should be in writing. It is important to note that HMRC cannot actually search the premises, so they can't search for particular assets or documents unless they have a warrant in a criminal case. They can also issue third-party notices requiring the third party to provide information or documents, again, reasonably required to check another person's tax position. In most cases there, HMRC must give a copy of the third-party notice to the taxpayer. So I mentioned reasonably required before. So what does that actually mean in practice? What it means is that it's reasonable for the officer to require the document or information, particularly to check the tax position. So what is actually reasonably required is going to depend on the facts of your individual case. But as an example, it could include documents relating to your actual business transactions or your business bank statements. It would be advisable to seek professional advice so that any requests in that notice can be carefully considered. So there are some conditions that actually need to be met before the information notice can be issued. So those conditions are, it must be only used to check your past, present or future tax liabilities. And as well as the information or the documents being reasonably required, HMRC must have given formal notice of inquiry into the taxpayer's tax return if a return has been filed. Alternatively, if that hasn't happened, they must have a really good reason to suspect that there's been an amount that's actually been underassessed in your tax return or hasn't been assessed at all. The notice itself must be in writing, must also specify the period for which the information or documents are required. And also how you need to provide that information. They do sometimes actually ask for electronic documents now, as well as written documents. Okay, so what happens if you do not comply with the information notice? An information notice under Schedule 36, it is a legal request. And failure to comply will lead to penalties and quite steep penalties as well. So you could be liable for an initial £300 penalty for failing to comply by the given date, and then further daily penalties of up to £60 per day until the request is met. Penalties will also be imposed if any of the information or the documents are inaccurate, or if you've concealed anything or got rid of anything that you should have kept. If you don't agree that the notice should have been issued, it is possible to appeal. You have to do that in writing, and there's a statutory 30 days within the date of issue to make that appeal, and you must state your grounds of appeal when you set that in. It is also possible to appeal against the notice to the tax tribunal directly. However, sometimes HMRC will already have gained approval from the tribunal, and in that case, it's not possible to make an appeal. Also, it's not possible to appeal against providing anything that's part of your statutory records. Okay, and just some sort of further key points to consider about these notices. Generally, HMRC will request information informally, and then only issue a Schedule 36 notice if that informal request isn't met. So basically, it's in your best interest to comply during an inquiry with any informal requests, just so that you avoid perhaps receiving a Schedule 36 notice, which obviously then does carry the risk of hefty penalties if you don't comply. So if you are unfortunate enough to receive one of these notices, first of all, don't panic. But if you do wish to seek professional advice, make sure this is within good time of the deadline, and bear in mind, obviously, that there are only 30 days to appeal. Don't be afraid to ask HMRC if you're not sure of anything. If you don't understand why they're asking a particular question or why they're asking for a certain piece of information, you can go back to them and just check that is actually needed to check your tax position. An information notice only requires you to produce a document if it's actually in your possession or power to do so. Also, if the document they're asking for is quite old, so if it's from more than 6 years ago, then the notice must have been agreed by an authorised officer, so you can check that has happened. The documents that HMRC is requesting must be clearly described in the notice and easily identifiable. So, for example, excuse me, they can't just ask for bank statements. In general, they would need to say bank statements from your particular business account between these dates. Also, they must give you sufficient time to comply with the notice. Obviously, you know, they may be asking for a lot of information that can take some time to gather, and it may in fact be possible to appeal against the notice on the grounds that the time allowed is insufficient.
So I'm going to talk about discovery assessments. So HMRC will send a discovery assessment after the normal inquiry window is closed. As we learned before, that is within the 12 months. It's important that when you do receive a discovery assessment that you check that it's valid. We see a common theme here of HMRC issuing discovery assessments right before the 4-year limit. We usually see them sort of around the 3rd, the 4th of April of that 4-year. If you do receive a discovery assessment that looks like that, then please send it in and we'll be able to hopefully challenge that. HMRC tend to send discovery assessments as a sort of a way to cut the inquiry process. They have to evidence when you do receive the discovery that income and gains have not been assessed. Usually when you receive a discovery assessment, it will come with a computation and they'll usually explain why they believe that should have been included originally in your return. So HMRC have normal assessment limits of 4 years after the end of the tax year. This can go up to 6 years if they believe there's been careless behaviour, and it can also go up to 20 years if they believe there's been deliberate behaviour. A second condition which HMRC can open the discovery assessment is if, just bear with me a second. Is when the inquiry window has been closed, or when an inquiry into the taxpayer's return was completed, the officer could not have been reasonably expected from the information made available to him before that time to be aware of the relevant loss. That part is one of the most important bits. As a discovery assessment would suggest, it is discover. So it's what they had discovered after the 12 months that would have inclined them to open a discovery assessment, and that is why it is important to challenge discoveries, because when we challenge discoveries, we do tend to see that HMRC have had that information for a significant period of time, and in theory they haven't actually discovered anything additional to what they already did. There's been a great deal of case law, particularly cases such as Beagle and Tooth. They've examined the concept of a discovery becoming stale, which therefore makes it invalid. Again, that is, that's from the date that the discovery came about to the date that the actual assessment was sent out. The term stale is where the actual discovery and the date that the notice was sent out, there was a significant period there, therefore the actual discovery has become stale. In many cases, assessments can be successfully challenged by experienced tax investigations firm. We've successfully challenged a number of discovery assessments on that basis, that what have they actually discovered. This usually includes things like white space disclosures, when HMRC have obviously had all of the information. If people have used an avoidance scheme, that everything is included in there, therefore there has actually not been anything new discovered. Here is an example of a discovery assessment. As you can see from the previous inquiry letter that we showed you, it's not significantly different. Again, the address is on there, the date, but if you go to where it says I enclosed the notice of assessment to income tax for the year 12-13, and then it goes on to say what provisions this notice has been given under. So as you can clearly see, it's not a section 9A as previously shown, it's under the discovery provisions. These letters tend to say why they believe there's an additional tax charge, and will also include, as I said, an actual computation of what they believe the actual tax to be due. It's important when you do receive a discovery assessment that you do respond within the time frame. It's usually 30 days. It will say paying what is due, and then it will give a date, which is usually 30 days after the date of the letter. So it's very important if you do get a discovery assessment that you either seek advice or appeal it. And this will put a stop on the actual payment becoming due, and also won't include the penalties which are listed there for the 30 days, the 6 months and the 12 months. So it's very important that you do that. Just a little section on penalties. I've got a little breakdown here of why a penalty will be due. A penalty will usually be issued once the inquiry has been closed. And it can arise from a lack of reasonable care. The level of the penalty usually depends on the reasons for the error, and that's something that HMRC call potential lost revenue. Potential lost revenue is an additional amount of tax which is due and payable as a result of correcting the inaccuracy. I've just given an example below of what those percentages are and what they're for. A penalty can arise because of a lack of reasonable care. This can be anything between 0% and 30%. If the error is deliberate, the penalty can be anything between 20 to 70% of the extra tax due. And lastly, if an error is deliberate and concealed, the penalty can be anything between 30 and 100% of the extra tax due. So, we're talking significant amount here. This can be reduced if you tell HMRC about the error. HMRC can make further reductions depending on the quality of the disclosure as well. So it's important to do that if you do believe you fall within that deliberate category. Again, if you tell HMRC about the errors, help them work out what the extra tax is and give them access to figuring out what those figures are, that will also give you a reduction in the penalties. So we're going to go on now to COP 8. So I'm going to pass that back to Claire.
Okay, so we're going to discuss some further types of inquiries. The first one, as Lydia said, is COP 8. So COP 8 or Code of Practice 8. So HMRC Fraud Investigation Service investigate under COP 8. And they do that in cases where they suspect there may be a significant loss of tax. I suppose significant, we're probably talking in excess of about $500,000. So what happens is they may open their own investigation, or they may actually take over an existing inquiry. A COP 8 investigation will usually target what's commonly sort of termed as tax avoidance schemes or arrangements, particularly those which might involve offshore aspects. It is a serious investigation. The penalties are very steep. They can be up to 100% of the tax for any onshore matters and 200% for offshore. And if the FIS find any evidence at all of fraud, they may transfer the case to COP 9, which is Code of Practice 9, or even start a criminal investigation. So what might happen during a COP 8 investigation? Well, HMRC will advise you of any investigation in writing. They don't have to tell you the reason for starting the investigation, although it is likely that they most probably will. And during the investigation, you're likely going to be required to provide pretty extensive information, as well as possibly attend formal meetings. So I mentioned Code of Practice 9 or COP 9, and this is used particularly where HMRC have reason to suspect tax fraud. It's the most serious type of civil investigation undertaken by HMRC. So what happens during a COP 9 investigation? Well, you'll be offered the option of making a disclosure under an arrangement called a Contractual Disclosure Facility, or CDF. It will require you to admit to deliberate behaviour which led to the loss of tax, and submit a full disclosure report within 60 days. So that's quite a short time frame. And then in return for that disclosure, and your full cooperation and settlement of any tax and penalties due, HMRC will then agree not to pursue you in a criminal prosecution unless you've made an inaccurate disclosure, and you will need to sign a certificate of full disclosure confirming that all your tax affairs are now up to date. The Contractual Disclosure Facility is also available if you want to bring your affairs up to date voluntarily. For example, you know, if there's something that you should have declared but you didn't, it's a good idea to do that voluntarily rather than waiting for HMRC to catch up with you. So I think we've explained, you know, they do have many sources of information, so they probably will catch up with you in the end. So why should you speak to a tax advisor if you receive a form of inquiry or a discovery assessment, or COP 8 or COP 9? Well, these types of inquiries and investigations can be really stressful, and they can be very costly, and of course time consuming. And professional investigations companies are aware of the sort of HMRC trends, and they will be able to quickly understand the office's concerns and be able to address them in full. In particular, COP 9 is really high risk, because if you fail to provide correct information, it could lead to a criminal investigation rather than civil, as is usually the case. So therefore, seeking expert advice is really essential to ensure that you are compliant throughout the process, and that you can mitigate costs where possible, and achieve the best outcome. I think we're now going to take some questions if we have any.
None just yet.
Okay.
We'll just give it a few minutes just to see if anyone's got any questions that they want to send through, and we'll read those out and hopefully be able to answer them.
We obviously covered everything in such great detail that you don't feel the need to ask us anything.
Let's give it a few more minutes.
Okay, as I said, looks as though we must have covered everything, which is great. I think if we've got the last slide up now, does have our contact details. So please, if you have any questions, or if you receive any inquiries and you need some help, then please feel free to contact us. Thank you.